Oil palm versus cashew. Which plantation is the better long-term investment? Have you ever wondered why some investors plant oil palm while others choose cashew, even though both are considered long-term agricultural investments? If you had the same piece of land and the same amount of money, which plantation would actually make you wealthier over the next 30 years? The answer is not as obvious as many people think. Many people assume the crop with the highest selling price is automatically the better investment. That isn't true. The best plantation isn't simply the one that produces the most valuable product. It's the one that matches your capital, your location, your risk tolerance, your management ability, and your long-term financial goals. Today, we're comparing two of the world's most important perennial crops, oil palm and cashew. We'll compare startup costs, time before earning income, maintenance requirements, profitability, labor needs, market demand, risks, lifespan, and long-term wealth potential. By the end of this video, you'll have a much clearer idea of which plantation could be the better investment for you. Let's begin. First, understand one important fact. Neither oil palm nor cashew is a get-rich-quick investment. Both require patience. You're planting trees, not vegetables. You invest today so the plantation can generate income for decades. This is why wealthy families and institutional investors often own plantations. They're building assets that can produce cash flow long after the initial investment. But although both crops are long-term investments, they behave very differently. Part 1. Time before you earn money. One of the biggest differences is how quickly each plantation begins producing. Cashew usually starts producing small harvests in about 3 years. Commercial production often begins around years 4 to 5. Oil palm also starts fruiting around year 3. However, commercial yields generally arrive between years 4 and 5, with production continuing to increase until roughly years 8 to 12. So neither crop gives you meaningful income immediately. Both require patience. If someone tells you you'll recover your investment within 1 or 2 years, be skeptical. Agriculture rarely works that way. Part 2. Lifespan. This is where both crops become interesting. A well-managed oil palm plantation can remain productive for approximately 25 to 30 years before replanting becomes economically necessary. Cashew trees can remain productive for 30 years or more, and in some cases much longer with proper management. However, productivity is what matters, not just tree age. An old tree that produces very little isn't necessarily a good investment. Part 3. Land productivity. Now let's compare how efficiently each crop uses land. Oil palm is one of the highest oil-producing crops in the world. Per hectare, it produces significantly more vegetable oil than soybean, sunflower, or rapeseed. That's one reason it's widely grown in tropical regions. Cashew produces nuts rather than oil. The value comes from the edible kernel, the cashew apple, and in some markets the shell liquid used in industry. Because these are completely different products, comparing them by kilograms alone can be misleading. Instead, investors should compare profit per hectare after costs. That's what ultimately matters. Part 4. Startup costs. This is where many beginners make expensive mistakes. Planting trees is only one small part of establishing a plantation. You must also consider land preparation, seedlings, planting labor, weed control, fertilizer, road access, drainage where necessary, fire prevention, security, equipment, transportation, maintenance, unexpected expenses. Oil palm generally requires higher initial investment. High-quality seedlings cost more. Land preparation is often more intensive. Fertilizer requirements are typically greater. Harvesting equipment eventually becomes necessary. Cashew generally has lower establishment costs. It often requires less fertilizer during establishment and can perform reasonably well on less fertile soils, although good management still improves yields. This lower entry cost is one reason many small farmers begin with cashew. But lower startup cost does not automatically mean higher profitability. Part 5. Maintenance. Many people think plantations run themselves. They don't. Every year requires management. Oil palm demands regular pruning, fertilizer application, harvesting every few weeks once mature, weed control, pest monitoring, and road maintenance. Harvesting cannot usually be delayed for long because ripe fruit bunches lose quality. Cashew maintenance is generally less intensive. Pruning, weed management, pest and disease control, seasonal harvesting. Compared to oil palm, harvesting is concentrated into a specific season in many producing regions. That can reduce labor requirements during parts of the year. Part 6. Labor is one of agriculture's biggest hidden costs. Oil palm requires frequent harvesting because fresh fruit bunches continue ripening. If harvesting is delayed, fruit quality and oil extraction rates decline. This means more consistent labor throughout the year. Cashew often requires intensive labor mainly during harvest season. Outside harvest periods, labor demand may be lower. If labor availability is limited or expensive in your region, this factor can significantly affect profitability. Part 7. Processing. Here's something many investors overlook. Oil palm and palm oil are not the same business. Growing fresh fruit bunches is one business. Processing them into crude palm oil is another business entirely. Processing requires machinery, fuel or electricity, water, maintenance, technical knowledge, quality control, storage, additional labor. Some plantation owners sell fresh fruit bunches directly. Others invest in processing facilities. Each approach has advantages and disadvantages. Cashew also has a processing sector. Raw nuts are valuable, but processed kernels usually command much higher prices. However, processing cashew is technically demanding because shells contain corrosive oils that require careful handling. Again, plantation ownership and processing are separate investment decisions. Part 8. Market demand. Both crops enjoy strong international demand. Palm oil is used in food, cosmetics, soap, detergents, biofuels, pharmaceuticals, and thousands of everyday products. Many people don't realize how often they encounter palm oil each day. Cashews are popular snack foods worldwide. They're also used in confectionery, dairy alternatives, baking, and food manufacturing. Demand for both crops has grown over decades. However, market prices fluctuate. No agricultural commodity rises forever. Planning your investment assuming today's prices will continue indefinitely is risky. Part 9. Climate requirements. Location matters more than enthusiasm. Oil palm performs best in hot, humid tropical climates with reliable rainfall. Poor rainfall or extended drought can reduce yields significantly. Cashew generally tolerates drier conditions better than oil palm. That makes it attractive in areas where rainfall is more seasonal. Choosing the wrong crop for your climate can dramatically reduce profitability. No management skill can fully compensate for unsuitable environmental conditions. Part 10. Risks. Every plantation carries risk. Oil palm investors face risks including price fluctuations, labor shortages, fertilizer costs, disease, flooding, drought, transportation challenges, processing bottlenecks. Cashew investors also face risks. Market price changes, pests, diseases, weather extremes, harvest losses, quality problems. The biggest mistake is assuming agriculture is guaranteed income. It's a business. Businesses involve uncertainty. Successful investors prepare for it. Part 11. Income pattern. One major difference lies in cash flow. Oil palm can generate relatively regular income because harvesting occurs throughout much of the year in suitable environments. That can provide more consistent cash flow. Cashew income is often much more seasonal. A large portion of annual earnings may arrive during harvest periods. This difference matters if you're depending on plantation income to cover regular expenses. Part 12. Scalability. Suppose your plantation becomes successful. Which crop is easier to expand? Expansion depends less on the crop itself and more on access to land, labor, capital, management systems, and markets. Many investors fail when expanding because they increase acreage before developing reliable management systems. A poorly managed 500-hectare plantation may earn less than a well-managed 50-hectare plantation. Size alone doesn't create wealth. Efficiency does. Part 13. Which plantation can make more money? This is probably the question everyone has been waiting for. Unfortunately, there is no universal answer. Profit depends on location, yield, input costs, labor costs, management quality, market prices, transportation, processing decisions, tree genetics, rainfall, soil quality. A well-managed oil palm plantation can outperform a poorly managed cashew plantation. Likewise, an excellent cashew plantation can outperform a neglected oil palm plantation. Management often matters more than the crop itself. Part 14. Who should consider oil palm? Oil palm may suit investors who can invest more capital up front, have access to reliable rainfall, can manage continuous harvesting, have access to labor or mechanization, want relatively steady production throughout the year, possibly plan to enter processing later. Part 15. Who should consider? Cashew. Cashew may suit investors who have a smaller startup budget, operate in areas with longer dry seasons, prefer lower maintenance intensity, accept more seasonal income, want a plantation with potentially lower annual operating requirements. Final verdict. So, oil palm or cashew? Neither is universally better. They solve different investment problems. Oil palm generally demands more capital and management, but it can provide more regular production and is backed by enormous global demand. Cashew usually requires a lower initial investment, can tolerate drier environments, and may fit investors seeking a less labor-intensive plantation. The real winner isn't determined by the crop. It's determined by the investor. The investor who understands cost before planting, the investor who chooses the right crop for the right location, the investor who manages the plantation consistently for decades instead of expecting quick profits. Agriculture rewards patience more than excitement. If you're planning for the next 30 years instead of the next 30 days, you're already thinking differently from most people, and that difference may become your greatest advantage. If you found this comparison useful, subscribe to the channel because every week we break down agricultural investments using practical numbers, realistic expectations, and business principles, not hype. Thanks for watching, and I'll see you in the next video.